Welcome. In this explainer, we're going to completely decode the complex, heavily gate-kept jargon of the trading world. Look, if you've ever opened up a trading platform and just felt totally overwhelmed by all the terminology, you are absolutely in the right place. We're stripping away all that confusion right now and equipping you with a practical, nuts and bolts understanding of Forex essentials so you can actually navigate these markets with confidence.
I mean, seriously, ever feel like Forex traders are speaking a completely different language? It's incredibly common to feel that way. The financial industry absolutely loves its buzzwords, but beneath all that intimidating vocabulary are actually some very, very straightforward concepts. So think of this explainer as your ultimate translation guide. We are going to translate that traders speak into plain, simple English so you can safely jump in.
Okay, let's dive into this. We're going to follow a trade from start to finish. 1. The basics of trading. 2. Money, leverage, and risk. 3. Reading market movements. 4. Protecting your trades. And 5. Trading styles and tools. Section 1. The basics of trading. Laying the groundwork. Okay, so in Forex, you're always dealing with a currency pair. And that simply means you're trading one money against another. That's it. Whenever you see a ticker, like the classic Euro/USD, you are basically saying, hey, I want to trade my euros for US dollars. You're just swapping one economy's currency for another's. That is the entire foundation of the market. Now, once you have your pair, you've really only got two choices. You can go long or you can go short. Let's make this simple enough for a 10-year-old to grasp, okay? Buying or going long is just like buying a toy today, hoping it becomes a rare collector's item so you can sell it for more later. You want the price to go up. But selling or going short, that's when you think the price is going to drop. Imagine borrowing that same toy from a friend, selling it immediately for $10, waiting for the price to drop to $5, buying it back to return to your friend, and boom, you just pocketed the $5 difference. You're literally profiting from the fall. Section 2. Money, leverage, and risk. Sizing up your trade. So now that we know what we're trading, we need to know how to measure our inventory. In trading, that's done in lots. Your lot size dictates exactly how big your trade is. A standard lot is a size of 1.00, and that carries a high risk because you are moving large amounts of currency. Step down to a mini lot at 0.10, and you're at a medium risk. Finally, we have the micro lot at 0.01, which is the absolute smallest and safest position you can take. Simply put, a bigger lot always means bigger money and for sure, bigger risk. Which brings us to the number 0.01. Listen, this is the absolute golden rule of trading. If you are new, you must always start with a micro lot. I can't emphasize this enough. This is how you stay safe while you're learning the ropes. Do not touch those standard lots until you are a seasoned veteran. And this brilliantly illustrates our next concept, leverage. Leverage lets you trade with way more money than you actually have in your account. Think of it like a borrowed superpower. For example, a 1 to 100 leverage means if you have $10, your broker lets you trade as if you have $1,000. But remember, superpowers can help you, but they can also hurt you immensely if a heavily leveraged trade suddenly goes the wrong way. To manage that risk, you have to monitor these 4 crucial account stats so you can keep your cash straight. First, your balance. That's your total starting cash before any trades. Next is equity. Think of this as your live cash. It's your balance plus or minus the real-time fluctuating results of your open trades. Then there's margin, which is essentially a security deposit your broker ties up just to let you open a trade. Finally, free margin. That's your available cash, the money you still have left to open new trades. Knowing the difference between your tied-up cash and your available cash is absolutely essential. Section 3. Reading market movements. Navigating the terrain. All right, let's step into the actual market environment. First up, a pip. This is the absolute smallest tiny step in price, like moving from 1.1000 to 1.1001. Then there's the spread. That's the small gap between the buy and sell prices. It's basically the broker's fee, so smaller spreads are always better for you. Next, volatility. This measures how fast and wild the price jumps around. High volatility means wild jumps, which is risky but presents big opportunities. And finally, the trend. This is your compass. Is the market moving in an uptrend, a downtrend, or just drifting sideways? When you're trying to visualize these market trends, it really helps to just imagine a bouncing ball inside a room. Support is where the price often stops falling. It acts exactly like a floor. Resistance is where the price often stops rising. It acts like a ceiling.
As a trader, you're constantly watching to see if that ball is going to bounce off the floor or the ceiling, or if it has enough momentum to break straight through. So, how do traders predict those bounces? They use two main methods. Technical analysis is essentially reading a chart map to predict future prices based on historical patterns. Fundamental analysis, on the other hand, is like checking the economic weather before going outside. You're looking at interest rates, job reports, the news, trying to figure out where the price will go. Usually, the really great traders use a bit of both, the map and the weather report. Section 4. Protecting your trades. Survival in the market. Okay, we're slowing down here because this is the climax of our journey. Survival and protection. Let's move to the chronological life cycle of a trade and see how this builds. You start at the entry point, the exact price you open the trade. Immediately, you're going to deal with the spread or slippage, meaning you usually start slightly negative because of the broker's gap. Then comes the nerve-wracking middle phase, drawdown, where you watch your trade temporarily lose money, or hopefully profit, where it moves in your favor. Finally, you reach the exit point, closing the trade for a win or a loss. But here's the thing. You shouldn't just rely on manual exits. You absolutely need automated protection. A stop loss is your financial seatbelt. It's a preset level that automatically closes a bad trade to stop you from losing too much money. I mean, you wouldn't drive a car without a seatbelt, right? So don't trade without a stop loss. On the flip side, take profit is a set goal that automatically closes a winning trade. It locks in your profit while you step away from the screen, so you don't miss out if the price suddenly reverses. But let me pose a very serious, urgent question right here. What happens when you don't use a seatbelt? What happens when a trade goes completely against you and you literally run out of free money in your account to hold the position open? Boom, you get hit with a margin call. This is the ultimate red alert in trading, and you want to avoid it at absolutely all costs. A margin call is an urgent, glaring warning from your broker telling you that you simply do not have enough money left to sustain your losing trades. The ultimatum? Add more money immediately, or the broker forcefully closes your trades at a major loss. This nightmare scenario is exactly what proper risk management is designed to prevent. And how do you prevent it? Math. Specifically, your risk-to-reward ratio. This measures how much you're risking versus how much you stand to gain. A solid trade setup looks for a ratio like 1 to 3. That means you risk $10 with your stop loss, but your take profit is set to win $30. When your potential reward far outweighs your risk, you literally don't even need to win every single trade to be highly successful. Section 5. Trading styles and tools. Choosing your path. So, now that you know the rules, you've got to pick a playing style. It generally falls on a spectrum. On one end, you have scalping. This is a very fast-paced, almost video game style of trading. Fast in, fast out in a matter of minutes to capture really small, quick profits. On the completely other end is swing trading. This is a much more patient approach. It's kind of like being a surfer looking to catch a big wave. You hold your trades for days or even weeks to ride out a much larger market movement. Regardless of your style, here is your essential survival toolkit. First, be aware of swap or rollover fees. This is basically a hotel charge you pay or receive for keeping a trade open overnight. Next, stick rigidly to risk management. The pros literally only risk 1 to 2% of their total money on any single trade, period. Utilize a demo account. This is your training mode with fake money, where you build your skills without real loss. And finally, build a trading plan. That's your personal rulebook that removes emotions and keeps you entirely disciplined. Well, we've laid out the map, translated the terminology, and stressed the absolute necessity of risk management. So I'm going to leave you with this final, critical thought to ponder. Are you ready to take these concepts and practice them safely in a demo account training mode? Or will you jump in blindly and let the live market dictate your very first and likely very expensive lesson? The choice and your financial future is entirely in your hands. Thanks for joining me on this explainer, and happy, safe trading.